As 2025 is halfway through, securing a solid financial future for retirement is a priority for many. You might be weighing whether to hold on to cash or continue investing to grow the wealth you've built. Let's look at the philosophy of Warren Buffett, a legendary investor who has proven that the right mindset is the key to becoming wealthy. This video will explore his core principles, offering valuable insights for personal financial management and fortifying your wealth as you enter this crucial stage. First, mindset, circle of competence. Invest in what you understand best. The concept of the circle of competence is one of the cornerstones of Warren Buffett's investment strategy. Simply put, it means he only invests money in sectors and companies that he truly understands, their business model, products, competitive advantages, and leadership. He doesn't try to be an expert in every industry, but focuses on accurately defining the limits of his knowledge and operating only within that circle. For Warren Buffett, knowing what you don't know is just as important as knowing what you do know. This may sound obvious, but in the complex financial world, where countless opportunities and pitfalls are always beckoning, adhering to this principle requires discipline and profound self-awareness. Firstly, at this stage of life, the primary goal in personal finance is often to preserve the wealth accumulated after many years of hard work, rather than seeking huge profits that come with high risks. You no longer have much time to start over if a wrong investment decision causes significant losses. When you invest in what you understand well, you are much better able to assess risks accurately. For example, someone who has worked their entire life in the automotive industry will have deeper insights into the potential and challenges of a car company than a newly emerging biotech company. This understanding helps avoid value traps or unrealistic promises from unfamiliar sectors. Losing money in retirement not only affects spending plans, but also has a major impact on morale and quality of life. Secondly, the investment world today, in 2025, is increasingly complex with countless new financial products, breakthrough technologies like artificial intelligence, blockchain, or rapidly changing market trends. It's easy to get caught up in the fear of missing out, FOMO, when seeing others seemingly making money from new opportunities. However, Warren Buffett always warns that following the crowd without real understanding is the shortest path to losses. For retirees, spending time and energy trying to grasp every new trend may be unrealistic and unnecessary. Instead, focusing on your circle of competence allows you to make decisions based on solid logic and analysis, not emotions or market hype. This helps you maintain calmness and clarity, especially when the market is highly volatile. Thirdly, investing in what you understand brings confidence and peace of mind. When you clearly grasp how a company generates profit, its market position, and potential risks, you will feel more comfortable holding that investment even during short-term market corrections. This understanding also helps you recognize when a company is genuinely facing fundamental problems, not just normal stock price fluctuations. This is in stark contrast to the feeling of insecurity and anxiety when investing money in something you don't truly understand based only on others' advice or a hot article. Financial peace of mind is an extremely important factor in fully enjoying your retirement years. So how can you, those in your golden years, identify and apply your circle of competence in managing personal finances and investments? Reflect on your professional and life experience. You have spent decades working and accumulating knowledge in one or more specific fields. That is an excellent starting point. An engineer might understand industrial and construction companies well. A doctor or nurse might have deep insights into pharmaceutical companies, medical equipment manufacturers, or hospital chains. A teacher might understand companies operating in the education sector. Even everyday consumer experiences are valuable. For example, if you have regularly used products from a well-known consumer brand for many years, you might have valuable insights into product quality, customer loyalty, and the company's position. Do not underestimate the rich knowledge and experience you possess. Prioritize businesses with simple, easy-to-understand business models. Warren Buffett prefers companies whose operations an average person can understand after reading their annual report. Companies providing essential products and services with strong brands and long operating histories are often easier to analyze than high-tech companies with complex products or business models not yet proven over time. For example, understanding how Coca-Cola makes money is often much easier than understanding how an AI-based software development company generates revenue. Warren Buffett's Circle of Competence mindset is an invaluable guide, helping you navigate investment decisions in your retirement years. By focusing on what you truly understand, you not only minimize risks and protect your wealth, but also build a solid personal financial foundation, bringing peace of mind to enjoy life. This is not a get-rich-quick scheme, but a sustainable, time-tested investment strategy. Moving on to the second mindset, another pillar in Warren Buffett's wealth building is patience is golden and long-term vision. Wealth needs time to flourish. In a constantly moving world where information travels at the speed of light and many seek immediate profits, Warren Buffett's philosophy of patience and long-term vision might seem outdated to many. However, it is his steadfast adherence to this principle that has helped him become one of the most successful investors in history. He often likens the stock market to a mechanism for transferring money from the impatient to the patient. For Buffett, investing is not a sprint to get rich quick, but a marathon where endurance and foresight determine the winner. He firmly believes in the power of compound interest, which Albert Einstein once called the eighth wonder of the world, which only truly unleashes its magical effect over a long period. The mindset of patience and long-term vision becomes even more essential in personal financial management. Why is this so? Firstly, while capital preservation is important, prudently maintaining and growing existing assets is equally necessary to ensure a comfortable retirement and cope with inflation. Increasing life expectancy means your retirement period may last longer than expected, and simply holding cash can lead to your purchasing power eroding over time. A long-term investment strategy focused on quality assets can help your assets continue to grow steadily even when you no longer have primary income from work. A long-term vision helps you navigate short-term market fluctuations, which are inevitable, to focus on sustainable growth potential. Secondly, patience helps you avoid emotional decisions, which often lead to mistakes. Financial markets are often driven by fear and greed. Daily news, stock price fluctuations, or advice from friends and colleagues can easily make you waver, wanting to sell off when the market goes down or buy massively when the market heats up. Warren Buffett always emphasizes the importance of keeping a cool head, not letting emotions overpower reason. For retirees, making hasty decisions based on temporary fluctuations can severely harm long-term financial plans. Patience allows you to wait until the fundamental factors of an investment truly change, rather than just market noise. One of Warren Buffett's famous quotes is, "Our favorite holding period is forever." And, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. These quotes don't mean you must hold an investment under all circumstances, but they emphasize the importance of choosing truly good companies, assets with sustainable value whose long-term future you believe in. This is particularly significant when you might be considering leaving a financial legacy for your children and grandchildren. A long-term investment strategy not only serves your own needs, but can also create wealth for future generations. So, how can you apply this mindset of patience and long-term vision to the practical management of personal finances in your retirement years? Focus on quality, not hype. Choose companies with solid business fundamentals, a stable operating history, sustainable competitive advantages, and trustworthy leadership. These companies are often better able to withstand economic cycles and deliver long-term value. This ties in closely with investing within your circle of competence. Consider stable income-generating assets. For retirees, patiently investing in assets that can provide a steady income stream, such as stocks of large companies with a good dividend history and steady growth, or high-quality bonds, can be a suitable choice.
This income stream can help cover living expenses and reduce reliance on selling assets. The power of sitting still. Sometimes the best action is to do nothing, especially if your initial investment thesis for a company remains intact. Warren Buffett has repeatedly demonstrated that patiently holding good investments through market ups and downs can yield superior results. Holding a reasonable amount of cash for flexibility and to seize opportunities is also part of a patient strategy, waiting for the right moment. A patient mindset and long-term vision do not mean blind passivity. It is about being proactive in carefully selecting investments, trusting those choices based on solid analysis, and allowing time to work its magic. In the context of 2025 and beyond, applying this philosophy of Warren Buffett will help you not only protect but also sustainably grow your wealth, ensuring a comfortable and financially independent retirement.
Following the two foundational mindsets, let's explore the third mindset, a core strategy that helped Warren Buffett accumulate extraordinary wealth. Smart value investor, buying wonderful companies at a fair price. The concept of value investing often evokes images of hunting for undervalued stocks, bargains in the market. However, Warren Buffett's philosophy has gone a step further. He doesn't just seek out cheap companies. He looks for wonderful companies and then patiently waits to buy them at a fair or even bargain price. This is a subtle but crucial distinction. His famous saying, "Price is what you pay, value is what you get," encapsulates the essence of this mindset. For Buffett, buying a business just because it's cheap can be a trap, because it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So, what makes a wonderful company in Warren Buffett's eyes? It's not just impressive numbers on financial reports for a quarter or a year. A wonderful company possesses sustainable competitive advantages, often called an economic moat, which protects it from competitors in the long run. This could be a strong brand trusted by millions like Coca-Cola or Apple, an extensive distribution network, low production costs, exclusive patents, or a superior corporate culture with a talented and honest management team. These factors create real intrinsic value for the business, helping it grow profits and stable cash flow over many years, despite economic fluctuations. After identifying a wonderful company, the next step is to assess whether the current market price is fair. Fair price doesn't necessarily mean the cheapest possible price. It means a price at which your investment has the potential to yield good long-term returns, commensurate with the quality and prospects of the business. Warren Buffett always looks for a margin of safety, that is, buying stocks at a price significantly lower than the intrinsic value he estimates. This margin of safety acts like a protective cushion, helping to minimize risk if his analyses are not entirely accurate or if the market behaves unfavorably. For you, this smart value investor mindset offers practical benefits for personal financial management. Firstly, it helps you minimize risk. Focusing on high-quality companies with strong economic moats helps minimize the risk of capital loss compared to investing in weak companies with cheap stock prices but unstable business fundamentals. In retirement, preserving accumulated wealth is a top priority. Secondly, sustainable growth potential. Wonderful companies often have the ability to continue growing profits and value over time, even in difficult economic environments. This helps your assets not only to be preserved, but also to have the opportunity to grow, contributing to a comfortable retirement and coping with inflation. Thirdly, generate passive income. Many wonderful companies with abundant cash flow often have policies of paying regular and growing dividends to shareholders. This source of passive income can be an important part of a retiree's financial plan. How can you apply this mindset to your investment practice? Research and learn. Take the time to learn about businesses, not just look at stock prices. Read annual reports, analyze competitive advantages, and assess the quality of management. This is part of expanding the circle of competence we discussed. Focus on intrinsic value.
Try to estimate the true value of a company based on fundamental factors, rather than being swayed by short-term market fluctuations or crowd psychology. And finally, seek a margin of safety. Always try to buy at a price that gives you a safety cushion in case your predictions are not entirely accurate. By applying the mindset of buying wonderful companies at a fair price, you are following a path that Warren Buffett has proven effective for building and protecting wealth sustainably. This is a strategy that requires patience, discipline, and continuous learning. But the reward for these efforts is a solid financial foundation for joyful and independent retirement years, even in the challenging context of 2025 and beyond.
After mastering Warren Buffett's 3 important mindsets, we now come to a foundational principle, perhaps his most famous and vital in his investment philosophy. The top priority is capital preservation, rule number 1 and rule number 2. Warren Buffett encapsulated this principle very simply and memorably. Rule number 1, never lose money. Rule number 2, never forget rule number 1. It may sound obvious, but the depth and importance of these 2 rules, especially for you, those in retirement, cannot be understated. At this stage of life, protecting the wealth you have diligently built over many years of hard work becomes the absolute priority in personal financial management. Losing money at this age is not just a declining number on your balance sheet. It can directly affect your quality of life, peace of mind, and financial autonomy during years that should be enjoyed in comfort. You no longer have much golden time ahead to recoup significant losses from misguided investment decisions. In the economic context of 2025, when the market may harbor unpredictable volatility and interest rates could remain high, emphasizing capital preservation becomes even more urgent. A 50% loss requires a 100% gain just to return to the break-even point, an incredibly difficult task, especially when primary income from work is no longer available. Therefore, avoiding unnecessary risks and focusing on preserving what you have is a wise strategy to ensure your wealth is not eroded. This capital preservation mindset does not contradict the goal of asset growth. On the contrary, it is the foundation upon which wealth can grow sustainably. When you avoid large losses, smaller but stable profits have the opportunity to accumulate and harness the power of compounding over time. Warren Buffett understood that the path to long-term financial success is built on prudence and effective risk management, not on gambles of chance. How can you apply this golden rule to managing your personal finances and investments in your retirement years? Understand risks before investing. Before putting money into any investment channel, ask yourself, what is the worst-case scenario risk? Can I accept that loss? This ties closely with the circle of competence. Only invest in what you understand well so you can accurately assess the risks. Be cautious with debt and leverage. Using borrowed money to invest can amplify profits, but it can also frighteningly amplify losses. For retirees, limiting debt and avoiding leverage in investments is a crucial measure for capital preservation. Keep some cash in reserve. Having a ready supply of cash not only helps you cover unexpected living expenses, but also provides the flexibility to seize good investment opportunities when the market corrects sharply, without having to sell off other assets at an unfavorable time. Warren Buffett's rule, never lose money, does not mean that every investment must be immediately profitable, or that no investment will ever incur a loss. The market always has fluctuations. What matters is that your overall mindset and strategy must be geared towards minimizing the risk of permanent loss of your core capital. By making capital preservation your top priority, you are building a strong shield to protect your financial achievements, ensuring a secure and independent retirement. Independent thinking and contrarian action. Temperament is more important than IQ. Warren Buffett once asserted that to invest successfully, you don't need to be the smartest person or have a superior IQ. Instead, what is truly necessary is a stable temperament, an ability to maintain composure and think independently, not being swayed by the emotions and behaviors of the crowd. Financial markets, especially the stock market, are often dominated by two basic emotions: greed when the market goes up and extreme fear when the market plummets. It is these emotions that often lead the crowd to make erroneous investment decisions, buying at the peak of euphoria and panic selling at the bottom of pessimism. Cultivating the ability to think independently and act contrary to the crowd when necessary is extremely important. When information spreads rapidly and experts continuously offer conflicting predictions, maintaining a stance based on your own analysis becomes more valuable than ever. If you merely follow temporary advice or tips for getting rich quick without careful due diligence, you are very likely to make decisions that harm your long-term personal financial plan. One of Warren Buffett's timeless quotes is, "Be fearful when others are greedy, and be greedy when others are fearful." This saying does not promote recklessness. Rather, it encourages independent analytical thinking. When the market is overly euphoric and asset prices are driven up irrationally, far exceeding their true value, that is when it's time to be cautious, fearful. Conversely, when the market is mired in pessimism, when bad news abounds, and many people panic sell their assets, that may be when opportunities to invest in good companies at bargain prices appear. That is when it's time to be greedy in a calculated way. Instead of blindly listening to others, learn to do your own research and analysis. Never invest money in something just because someone else says it's good. Research it yourself, evaluate it based on your circle of competence and the value investing principles we have discussed. And don't forget to prepare mentally for volatility. The market will always have its ups and downs. Accepting this as an inevitable part of investing will help you maintain composure and avoid making hasty decisions when the market fluctuates. Maintaining a reasonable amount of cash also helps you feel more secure and ready for opportunities. By cultivating independent thinking and the ability to act contrary to the crowd when necessary, you not only avoid common market pitfalls, but can also find wealth-building opportunities that others miss. This is the quality that helped Warren Buffett make a difference, and it can also help you steer your financial ship steadily through the turbulent waters of your retirement years. We have explored the 5 core investment mindsets that have defined Warren Buffett. Sustainable wealth is not the result of fleeting luck, but comes from the consistent application of these golden principles to personal financial management. Begin your journey of strengthening your financial future for your retirement years, even in the context of 2025, by internalizing and applying these invaluable lessons.